Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dmitry Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer. And with that, let me share my screen. If you guys have any questions, you could put those questions in the live chat. Will's watching it. He'll read it back to me. If anybody wants to come on the show and ask their question live, we also provide a link to Zoom. If you click on that link, it takes you over to Zoom. Once you get to Zoom, there's a button, raise your hand. Click on that button. That alerts us. You don't have to turn on your video camera, but once we let you in, everybody will hear you. You could ask your question directly, navigate us to what you're looking at. So those are two ways to ask the questions. And while we're waiting for questions to come in, what we'll do today is take a look at the pre-market report, see what's trading in pre-market hours. I'm also going to take a look at SPY from a volatility perspective, maybe a seasonality perspective, get some insights, how the market has been moving this year. So I wanted to kind of show you guys how that volatility has been changing. And we'll take a look at the monthly returns this year compared to historical levels, just to get a perspective of the liquidity and the volatility right now we're experiencing in the market, in this tightening cycle, in this tightening interest rate environment. So let's start with the pre-market report, and then we'll move on to that. If questions come in, we'll stop me and we'll get to those questions.
All right.
Sound good? So
Perfect.
This is the pre-market report, and these are stocks that are trading the pre-market hours. We have our most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, I see 268 stocks made our percentage gainers list, 36 on the decliners. So right now, from this perspective, we're looking like a more bullish bias at the open. Let's take this report and filter it down to just S&P 500 companies. So we're going to take out closed-end funds, preferreds, ETFs, leverage products, low-cap stocks, everything, just to see what's going on in the S&P 500 companies. And I'm going to use this filter up here in ETF, drop it down. And here I got a list of ETFs. I'm going to choose the top one, SPY, which is the S&P 500 ETF. And that will filter out the list below by the stocks that are holdings in SPY. So here we see 68 stocks made our percentage gainers list, none on the decliners so far. So here, overwhelmingly, we're looking like a more positive bias at the open. Yesterday, we're going to take a look at it, how we ended September, how October's starting out, and what, how did the market tend to behave in October and November. There was some news I wanted to mention. Yesterday, the United Nations, of all people, came out and then started to issue statements that the central bankers here in the US and around the world should slow down, because what they will do is cause a global recession as a result of tightening interest rates, of over tightening. So I came here just to show you guys this is a CNBC article summarizing what they were saying. So here you go. United Nations sounded off, warning that the world is on the edge of a recession. And let me come up here. And they're basically calling for the central bankers to reverse course on the Fed, on the tightening. But What I did want to show you is there.
So let me ask, so the market, do you think the market's up on that news and that news alone?
Somewhat. I think that the market right now is very the volatility we're seeing today, and we're going to take a look at the volatility this year, is a lot. First of all, liquidity is getting taken out, right? So a lot of liquidity is taken out. We're going to see more volatility, and the bid-ask spread is widening out, like we're seeing in other places like real estate and so forth. The real buyers and real sellers, but that bid-ask spread keeps widening out. And a lot of these models right now, we're seeing the volatility. They're, they don't know how to price. There's a lot of uncertainty. The worst case and best case scenario are widening out. It's very hard to predict, and these competing models don't know where to price it. They're changing them very quickly. So I think that people are reacting to what the Fed is doing, right? And the Fed is like, the biggest central banker in the world right now. Are they going to slow down, pivot, and so forth? And I think that the markets are reacting to it, because in the last, 10 years, in the last decade, we've had very easy money, and the Fed kind of got us used to that, right? And we're expecting it, that money will eventually be easy again. This is temporary. They're going to go back to easy money policy. And, and everybody wants it, because it's kind of like getting everybody addicted to crack, and then taking the crack away, you start having withdrawals, and everybody's asking for that crack back. So it's not going to be that easy, for the Federal Reserve, I don't think, to reverse course in this environment, not yet. And lower interest rates, and I don't even know if they could. They still might have more tightening to do. But I'll show you. They came up, so the United Nations came up with their own suggestions, right? So they said, and they're worried about a recession. And I think that a recession itself, sometimes it's necessary to correct mistakes, right? So we all acknowledge that there are some mistakes done by the central bankers. They moved too slow. Inflation got out of control. And sometimes a recession is necessary to make corrections in the economy, get things back into balance. And everybody wants to avoid a recession. And a recession is different than depression, right? It's depression, of course, you don't want that. But a recession is a slowdown in your economies, slowdown in output, to get things back into balance. And I think that a recession sometimes is necessary, just like a company, when Nike makes a mistake and overproduces the inventory, and they have too much, what do they have to do? They have to discount it and get things back into line. Nobody wants to do that. It's not, it's going to be painful. It's not going to be pleasant, but it's a necessary step to get yourself back into balance, so you could have going forward, you could be healthy. Or they could just sit on that inventory and hope that demand just goes back up and they could get those big prices. But really, the necessary step is to get yourself back into balance. And sometimes, in this case, if mistakes were made, the recession might be necessary, and they want to avoid it. So these are their suggestions. Well, so here they go. We still have time to step back from the edge of recession. Nothing is inevitable. We must change course. We call then for a more pragmatic policy mix that deploys, and here we go, strategic price controls, windfall taxes, antitrust measures, and tighter regulation on commodity speculation. Yeah. So this is their now. All
That
this
seems like a recipe for higher prices.
exactly. They should take they should take a look at what they were doing in the Soviet Union.
And
Very similar,
Venezuela and Cuba.
same exact rhetoric. This here was a policy, right? This here was a policy. Yeah, you could put in price controls and say you can't charge higher than this. You could create windfall taxes on oil companies or whatever, antitrust measures, tighter regulation on commodity speculation. But all this doesn't solve the problem of that the supply and the demand is out of balance. Even if you put in price controls, that does not increase the supply, right? The demand will remain there. And what you have, like they did in the Soviet Union, is that, yeah, you could go and to the supermarket and the prices are low, but the shelves are empty, right? Because you can't produce that supply. It's not possible to fulfill that demand, right? So you're going to look at empty shelves. You're going to look at it destroys the economy in a different way. Windfall taxes. What does that do? A windfall tax is a tax on return on investment, right? That's what it is. Nobody wants to make an investment that the return is going to get taxed away. So if you're not making the investment, that is not increasing production and output, right? So you need investments, right? Look at the regulations on commodity prices. The future prices themselves can go up. Of course, speculators could also push those future prices up. But what that does is allow the producers to say, now, if I could get those prices and lock them in and hedge them, I could produce more today. And what they are doing is it incentivizes production and investment into commodity, right? Into producing more corn, more more meat, more lumber, more whatever. If the future prices are dictating that, and if you hold that down, what you're doing is discouraging the investment in production. So all these proposals here are not going to resolve the issue that we're experiencing right now. And I do believe that sometimes a recession, nobody likes it, but it might be a necessary step to bring us back down into balance. The economy needs to get into balance where that you don't want to see price instability. You don't want to see that, because that's going to be more painful in the future and much harder if you put it off to contain. So just kind of wanted to bring that up because that did come out yesterday and I was reading about it. And I don't think that the central bankers believe that those policies will work. But, I think that the markets were reacting to it in the sense that maybe central bankers will pivot from pressure.
It does seem like there's a lot of drum beating out there to try to force Powell to step back from his, target rates. On CNBC, they have Sterling was on again this morning. They brought him in all the way from, he was in Asia on a business meeting again to complain about, what's going on in the real estate market and how, housing values are going down and you can't get loans and, and he's at the top of his lungs shouting that the Fed's making a horrible decision here, and it's almost like people are promoting that, where right. It seems like Jay Powell to me is doing the logical thing to try to fight. I mean, it's not like he's taken the risk-free rate and put it at the inflation number, right? That would be the way to really stop it.
Yeah.
He's slowly going. I mean, it's not like,
he's going as slow as he can.
Yeah.
And, to not let it get out of control. Yeah, right now we're at 3%. The Fed funds is at what, 3.25%. That's not very high. You know, the mortgage rates, and it was a ridiculously low mortgage rate. We're, I think, at 3%, 30 years, and people got addicted to it. They thought that that's the normal, that the Fed is just going to continue to give away money, below the rate of inflation forever. So everybody calibrated that way. A little bit, they waited too long. And the perception right now, that when I talk to, businessmen or, realtors or in sectors that are interest rate sensitive, the belief is that this interest rate tightening cycle is going to be short-lived, and we're going back to that easy money policy, that eventually they're going to go back to where we were, to easy money. Mortgage rates are going to go back down to the same levels we've seen or close to it. And that's right now the perception that,
well, it's also
that's
that's showing up in the plot, right?
That's showing up in the plot,
Yeah.
And now that's something that they also have to battle with. It's the perceptions, the expectations. They said that inflation expectations, right? They can't forecast it. They can't even, there's no way to know it, right? But they're worried about it because there's still trillions of dollars out there to be spent. There's lots of money in bank deposits earning zero interest right now. So, they still have to battle with the expectations.
Yeah, to try to get that risk-free rate or go out to a 2-year treasury, it's not easy, right? Your brokerage account has to be set up correctly. It's not, and anyone who's out there, correct me if I'm wrong, it's not like you can go to your bank and say, I want my money in a 2-year treasury.
Yeah, exactly. So here, before I move on to the SPY seasonality, let me show you guys. This is in the last 2 weeks, we have a report, excuse me, stocks that gapped up in the morning, stocks that gapped down. So at the open, I'm actually doing a new report at the opening auction, but it's not ready yet. I think I'll show it to you guys soon though. But this is somewhat of a gap up at the open, gap down on the open. And what it does is follow the stocks after the opening, the ones that gapped up, the ones that gapped down. And as you could see here, that right now in the last 2 weeks, stocks that gapped up in the first half hour, they followed through on more gains. So 55% of those after the open continued higher by 10 a.m., 44% lower with an average gain of 0.2%. And by the close, 59% of them were higher, 40% were lower for an average gain of 0.4%. So what this is saying is that there has been follow through more often than not, right? Not 100% obviously, but more often than not, there has been follow through the rest of the day from the open to the drift. Let's take a look at just SPY stocks. So I'm going to choose S&P 500. And the data is down here below. So these are the stocks, what they did. And, so that's all the supporting data. But here's the summary. So first half hour, S&P 500 stocks that gapped up, it's been 50-50. Half were higher, half were lower. No real change. But by the end of the day, we could see similar to all the observations. These are 847 observations. 59% of those that gapped up basically opened on an uptick, moved higher. By the end of the day, 40% lower for an average gain of 0.4%. So that's what we've been seeing so far in the last 20 days, right? Last 20 trading days, almost a month. Let's move on to SPY because I am running out of time. And I wanted to take a look at the seasonality. And if you guys didn't see this before, this is SPY performance in the last 10 years. So here are the years, and here are each month. So how SPY performed for the calendar month, right? And we just finished September. You can see September down 9.6%. And right now we're in October, just yesterday up 2.6%. And if we look at the pre-market, we're up another 1.6% on top of that. Down here, we have the summary stats. And I'll show you September here is the only month in the last 10 years that the average return was negative. So you could see here, September has been the worst performing month in the last 10 years. As far as number of months that were up versus down, you can see 45% up, 54.5% down. And I'm going to come down here and show you that the median return was also negative. So not just the average, but the median return, basically the middle, was down. It's the only month here. Maybe January was unchanged, but the only calendar month that actually showed down on average and median. If we look at October, and here's what I wanted to show you as well. Here we see, down here, we see the max move up, max move down. So we take, for January, we take the biggest move up, 8%, and the biggest move down was 5.3% down here. So we get the range of the highest move up, highest move down. So you could see January set a new low. This in 2022, in the last 10 years, we set a new low here. February was kind of in between, March in between, but April, down 8.8%, that set a new low in the last 10 years. June set a new low in the last 10 years. We had a big move up in July that set a new high. And then September set a new low. So you could see how many of the months in January are setting new max move down and max move up. Just this year alone, what did I count? 1, 2, let me see, 3 here, 4. So far we're only 9 months into it. 4 of the months this year have set a new record, in the last 10 years, and we've had some volatile periods here. I mean, we had, you had the coronavirus here, you had some other events in there. So this is kind of indicating how much this year interest rates are having an impact on the volatility in the marketplace, right? The market itself, volatility is increasing. That's the impact of higher interest rates and easy money and liquidity getting taken out. Less liquidity, more volatility, harder to price these risk assets in general. And I think that will continue. I don't think we're at the end of that. Here, October, and usually, I've been looking at this coming off 2 straight down months. So we had 2 straight down months here, August, September. And just, I was kind of eyeballing them, today before the show, and usually have a nut month. I don't see, here's maybe 3, and this one is unchanged. So you got 3 months in a row. You got 2 months here, 2 big months, followed by nut month. But usually after 2 down months, you do get an up month. You get you get some relief here. And we had 2 big down months. One, 4%, 9.6%, which is, the worst September in the last 10 years. So October started out first day right away up 2.6%. And to give you guys an idea, at that volatility, and if we're adding another, let's say 1.6% today, well over 3%, here's the average return has been 1.5%. The average move, absolute move for the month of October, up or down, has been 3.9%, right? 3.9% for the entire month. We're going to be almost there in first two days of trading in October if we, add another almost 2% today. The high move, 8.5% to the upside, down 6.9%. And even though we're looking at these, keep in mind, we've just set half of the, almost half of these calendar months have set new record down moves or up move just this year alone. So kind of giving you guys a peek on like what volatility is doing, how we're moving around. And if we do, if we kind of do see some strength here, and this just, if we're looking at, of course, it's going to be news driven. And, I think that those interest rates are going to start weighing in on the stocks. But if we're just looking from this perspective, we're heading up into November, which, wherever October, November tends to be a strong month. And it also happens to be the next interest rate hike, or as far as we know right now, that's what's projected, that in November, interest rates are going to go up. And I think we're still, in that 0.75%, 75 consensus is 75 basis points. We're right up at 9:30. Well, it sounds like no questions. Just
no, all good, D. Awesome job, buddy.
All right. Well, thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.